Hi, everybody. This is serving as your class today. Obviously, that you're watching this and walking through it with me. So please get your ebook open. We're going to go through quick study 5-4, 5-8, 5-10, and 5-11. And if you haven't done them yet, which I certainly hope you have, but if you haven't, you can do it with me by just pausing and restarting the video while you watch it. So we're going to go over those four problems. I'm going to lecture a little bit more and do some recap from chapter 5. And then for class on Monday, for the next class, please do exercise 5-1 and exercise 5-3, and we will go through those and then continue to lecture. Also, a little reminder that your reading quiz for chapter 5 is due this weekend. Some of you have not been doing those. It really adds up. You get 2 passes, and then every other one past that, you're just losing 15 points. So please do that. Okay, so let's turn to quick study 5-4, and it asks us to compute the amount to be paid for each of the 4 separate invoices, assuming that all invoices are paid within the discount period. So we're looking at a company that is now purchasing inventory and marking it up and reselling it. So I can be, a ski shop, I can be a retail outlet like Target, I can be a clothing shop, I can be a pet food store. I mean, I'm buying inventory, which is called merchandise inventory. I'm marking it up and then I'm selling it, right? So now I've got 2 things in my, at the top of my income statement. I don't just have a revenue line. I'm going to have revenue minus cost of goods sold. And cost of goods sold is an expense account. It's the first expense account we've seen that doesn't have the word expense in it. So when you set up your T account, it's got the plus on the left side. It's an expense account. It's the major expense account for a retail organization. So in this company, in this problem, QS5-4, I'm buying inventory, and I've negotiated with the person I'm purchasing it from, called my vendor. I negotiated with the vendor that if I paid within a discount period, then I get a discount off of full price. So let's look at A. It says that I bought $5,000 worth of merchandise, and the terms were 210 net 60. Okay, that's what the N stands for, net. So that means that if I pay within 10 days, I get a 2% discount. And in any situation, I have to purchase, I have to pay the full price, the full $5,000 within 60 days. So the question is, all these invoices are paid within the discount period. So how much did I actually pay for that $5,000 of merchandise? So please calculate what you think the amount is, turn it off, and then come back and meet me if you haven't done it. And the answer is right here. I paid $4,900 because I got to take a 2% discount. So you can either do it this long way, 5,000 minus 5,000 times 2%, or you could just go straight to this calculation, 5,000 times 98%, because I didn't pay 100% of the price because I got a 2% discount. So I actually wrote a check for $4,900. Okay, on the second one, I bought 20 grand worth of merchandise, and the terms were 115 net 90. That means I get a 1% discount if I pay within 15 days. And in any situation, I've got to pay the whole amount within 90 days. So I'm going to take 20,000. Figure out how much I paid if I paid within the discount period. And the answer is right here. I wrote a check for $19,800, 20,000 minus 20,000 times 1%. Or you could just go straight to 20 grand times 99%, and that would give you the same answer. Okay, so go ahead and work through, again, you can pause the video if you haven't done these yet and you want to work through them with me. So the third one, I bought $75,000 worth of pet toys. I'm stocking up for Christmas. And the terms that I negotiated with my vendor, which is who I purchased them from, is 110 net 30. So, and I pay within 10 days. I pay the vendor within 10 days. So I get that 1% discount. How much did I write a check for? And the answer is down here. $74,250, right? So 75,000 minus that 1%, or you could just go straight to 75 grand times 99%. And then the last one, I bought $10,000 worth of merchandise, and the terms were $315 net 45. I paid within the 15 days to take advantage of the discount. Therefore, I did not write a check for 10 grand. I wrote a check for 10 grand minus 3%, or $9,700. So this is purchasing inventory and paying for it within the discount period. So the question is here, if you set up a T account for inventory and you're journalizing the purchase of that inventory. So let's just try one here. So set up a journal. And let's go back to that first one, that 5,000 bucks. And let's put in what my journal entry was if I bought that inventory on April 6th. What did I do when I got the inventory? So turn off the tape, put the journal entry down. Okay, so what I did when I got the inventory is I debited my account called merchandise inventory. What financial statement does merchandise inventory show up on? It shows up on your balance sheet because it is a current asset. So when I got the inventory in-house, 5,000 bucks, and I told the vendor that I would pay them later. So my credit is to what? $5,000. Okay. Then I go back up again. So it said I get 2% off if I pay within 10 days. So the last day that I can pay this $5 grand that I owe my vendor, the last day that I can pay her is on the 16th of April to take advantage of the discount. And I want to do that. Okay. Now, this is how you construct the journal entry. We went over this before. I want you to think about this with me, and then we'll do the next one together. So the first thing I want to do is pull the accounts payable off the books for the full amount. How do I do that? Now my accounts payable is at 0. As well it should be. I have paid my bill. But this is where it gets a little wonky. How much did I write the check for? Go back up and look at A. How much did I write the check for? $4,900. So now I'm looking at my journal entry. I've got a debit of 5,000. I've got a credit of 4,900. What the heck? How do I handle that? That $100 discount is really what? It's a reduction in the cost basis of my inventory. In other words, when I go into that merchandise inventory account now, and I'm going to show you this. So your purchase, this is called a purchase discount, and that amount gets credited into Merchandise inventory. Why? Here's why. Set up a T account for me, please. And again, you know how hard it is for me to do these. So set up a T account, label it as, go back, go back. Set up a T account, please, for your merchandise inventory. Put your plus or minus in, and then let's go ahead and put in the debits and the credits in your merchandise inventory account. I want to show you what's going on. So let me see if I can do this. I can make So here's my T account. I'm going to label it merchandise inventory. I want you to all say to yourselves, what kind of account is it? Current asset. Therefore, it shows up where? Balance sheet. And my debit in the account is for the 5,000 bucks, right? So I'm going to put the $5,000 in my debit side. I can't, these T accounts, I can't get it. Yeah. You know, do you know what you're doing? So put 5,000 bucks into your debit side, $100 into your credit side, and then put the line and balance it out. So then you're going to have $4,900 in your debit side down here. That is the cost basis of your merchandise inventory. Because when you go to sell it and move it into cost of goods sold as an expense, the per unit cost for those bags of pet food, it's not 5,000 bucks, it's 5,000 minus the $100 discount. Okay, good. Let's go up now and try the second one. So what do I do? Let's say that in the second one on B, I bought $20,000 worth the dog houses. Okay, and it was 115 net 20, and I did that on 5/8. So please journalize how much the journal entry for purchasing those dog houses. Turn off the tape and I'll meet you. Then, so I got the dog houses. And I owe my vendor. I owe my vendor 20 grand. Now I've got 15 days to pay this and still get my 1% discount. So I have until the 23rd. Okay. What is my journal entry when I pay my vendor? Turn off the tape, get rid of the accounts payable account, credit cash for the amount that you think that you're going to pay the vendor, and then the balance goes into merchandise inventory. Okay, so again, same as before, I've got to get the entire accounts payable off, right? That's important. Always check that you get the entire accounts payable off. Second, credit cash for the actual amount you write the check for. And lastly, I'm missing a $200 credit. I can see that by looking at my journal entry. I am going to take that against the cost basis of my dog houses. And here is the finishing piece of this. If, say that this was purchasing, I don't know, 5,000 dog houses. How much did each dog house cost me? This is important because I have to look at how much they cost me before I can determine how much to sell them in my pet store, right? So find out for me how much each of those 5,000 dog houses cost me. Turn off the video, calculate it, and meet me. So originally the inventory, so I'm just looking at my T account of inventory, right? I've got a debit for 20,000. Then I got a discount, a purchase discount for $200. So the cost basis that I have in these are $19,800. And there was 500 or 5,000 dog houses. That means that each dog house, these are tiny dog houses, sorry, I did the math wrong in my head, has a cost basis of $3.96. These are miniature dog houses. So when I'm looking at this as the owner of the pet store, I'm like, boy, I need to sell them for something more than $3.96. My selling price, I look at this, I know what all my other costs are. I'm going to sell them for $10 each. Okay. All right, let's move on to the next one. If we have time, we'll come back and do some more of these. But this is just very important. This is the basis of our new P&L or our new income statement as a retail organization that has inventory. You know, I'm still gonna say income statement and pet food or pet store delight. Okay, great. You know, as of 5/31/23. But now my top of my income statement is going to look different. It's going to have the revenue, you know, like normal, right? But underneath it, rather than going straight into all my other expenses, my rent, my utilities, my wages, my interest, and all that, the first expense that I'm going to subtract is cost of goods sold. This is an expense account. And that is going to show me how much did I pay for the inventory, right? In other words, this, how much was that? And I'm going to take that against my revenue and come to a subcategory called gross profit. Then I'm going to list all my other expenses, rent and salary and wages and all that good stuff. Okay, so that's where we're moving with this. All right, let's go on, please, to quick study 5-8. Okay, so this is, I'm more of the same, but kind of a little bit more interesting. So let's read it. Prepare journal entries to record each of the following transactions. Quick study 5-8. The company records purchases using the gross method and a perpetual inventory system. And basically there's different methods of doing this. This is the one that we're studying. We're using perpetual inventory, which means that I'm constantly keeping the amount of my inventory updated. In the old days, we sometimes used something called the periodic inventory system, where you didn't always know exactly what was on hand. You had to go do a count once a month or once a year or whatever. Obviously, with digital systems and RFID inventory tracking and, you know, it's just much more sophisticated. So we use perpetual, and we are going to be using the gross method. So let's just go now on May 1st, QS5-8. I purchased merchandise with a price of $800 and credit terms of net 30. So journalize that. Turn off the tape if you haven't done it. Journalize just this simple purchase. Let's say now that I am a donut shop and I bought $800 worth of donuts. And it doesn't appear to have any discount terms. So super simple. I'm just gonna buy, debit inventory and credit payable, right? Then, okay, donuts aren't a good example because those are perishable. Let's just go back to the pet store and say that I bought dog chews. So then I go and I look at the shipment and I'm like, oh gosh, some of these, the packaging has been opened on them. I can't sell these. They may be poison or molded or defective or whatever. So I call up the vendor that I bought the dog chews from and I'm like, hey, I need to send these back. I'm returning $100 worth these dog chews. They're defective. Make the journal entry. Turn off the tape and then I'll meet you. Okay, so what do? I just return the inventory. So I need to decrease that account by 800 bucks, or I'm sorry, by $100. And then the amount that I owe my vendor is $100 less. So here's what I'm doing there. Okay, I'm returning my defective units. So now I've got a debit accounts payable and credit inventory, right? So if you set up your T account for inventory right now, you would see that you've got a debit for 800 and a credit for 100. And then same thing with your accounts payable. How much do you actually owe your vendor right now? 700 bucks. So make the last journal entry, please, on the 31st. I paid the amount due. Now I cut a check to my vendor because the terms were net 30. So it's 30 days out, right? On May 31st, I paid the amount that I owe him. Turn the tape off. Okay, so the journal entry to pay him is I'm going to debit accounts payable for 700 bucks because that's what's left in my T account. And I'm going to just write a check for it and credit cash. Okay, great. That was 5-8. Okay, 5-10. Now we're on the other side of it. Now, well, no, not the other side. So there's really two pieces to running a merchandising company, right? A retail company. One is you're managing inventory, right? You're buying inventory, you're trying to get a good price on it, and then you're going to mark it up and you're going to sell it to your customer, right? So when you make a sale, every time you make a sale now in a merchandise company, you've got to worry about two things, right? You've got to worry about recording the sales revenue. And then you've got to worry about recording the cost of goods sold. Again, cost of goods sold is an expense account. And I'm going to move the amount that the inventory cost me off of my balance sheet and onto my income statement. In other words, I don't have it. That inventory is no longer back in my warehouse. I just sold it. So I've got to credit inventory to decrease my asset. And I got to move it into cost of goods sold, which is an expense. Okay. So let me just say it one more time. Every time you make a sale in a merchandising company, you have to make two journal entries. When I was back, the first 4 chapters, we were just a service company. And I sold an hour of my time, right? As a CPA or an attorney or whatever. There was no inventory that I was managing. So I only had one journal entry. Okay, so E5-10, prepared journal, or I'm sorry, QS5-10. Prepare journal entries to record each of the following sales transactions. The company uses a perpetual inventory system and the gross method. On April 1st, I sold merchandise for 3,000 bucks with credit terms net 30. So I'm selling something to my client and I'm telling them, hey, you can pay me in 30 days. It doesn't look like I'm giving them an option to take a discount though. And the cost of the merchandise was 1,800 bucks. So I say I'm a wholesale grocer and I bought a bunch of lettuce from Southern California or Central Valley, California. and I paid $1,800 for it, and now I'm selling it to Good Food Store for $3,000, and I'm telling them pay me within 30 days. So I'm a grocery broker. Okay, so what do? I've got 2 journal entries, right? Here first, I have to book the sale of the lettuce to the Good Food Store. They're going to pay me in 30 days. I have to debit accounts receivable and credit sales revenue. Then I can't just stop there, because right now I've got $1,800 less inventory sitting in my warehouse, right? In my cold box warehouse. So I have to decrease my inventory by $1,800 and move it into an expense account called cost of goods sold. Now, pause. Let me give you some instructions and then pause the tape. If this was all I did all month in my company, what would you do on your income statement? Set up that little top section of the income statement I just showed you. Sales revenue minus COGS gives me gross profit. Turn off the tape and do that for me, please. This was all I did all month, was make this one sale. This is a negative number, so I'm going to put it in brackets. Okay. So I've got now, it looks like gross profit of $1,200. Gross profit is a term that means the amount left over to cover everything else. I'm now going to have all my other expenses: salaries, rent, utilities, repairs, depreciation. And then at the end of all that, I'm going to have my net income. So that's why this is so important, that whatever I'm paying for my inventory, I have to mark it up enough to get a gross profit that is sufficient to cover everything else. Okay, let's keep going with quick study 5-10. Now, what happens next? I start looking at, I go through all my boxes of lettuce, obviously, that I just got in. No, wait, I'm sorry. I sold it, okay, April 4th. The customer in the April 1st sale, in other words, the Good Food Store, returned $300 of lettuce to me. It was no good. It was moldy, or it was rotten. The merchandise, which had cost $180, is returned to inventory. Okay, again, lettuce, probably not the best example because you're not gonna be able to resell it. But let's say that maybe now I sell it for pig food. Okay, but just stick with me here. So the Good Food Store is like, oh my gosh, I paid $3,000 for all this lettuce, and $300 of it is no good. I'm sending it back to you. So I've got to record the fact that I really didn't have $3,000 of sales, and they really don't owe me $3,000 anymore. They owe me $3,000 minus 300. And also, and again, lettuce was not a great example, but let's just keep going with it. I've got to record the fact that I've got another $180 back of inventory that's going back into my warehouse, and therefore was not really an expense at all. Okay, turn off the tape. What do? I'm going to use, for the sales, I'm going to use a contra revenue account called sales returns and allowances. Turn off the tape. You've got 2 journal entries, and then meet me back here. Okay, so April 4th. The first thing I have to do is recognize that I've got to debit sales returns and allowances. And I've got to credit accounts receivable because they don't owe me that $300, do they? Okay, so let's see what that looks like. So April 4th, debit sales returns and allowances. I'll show you what happens to that account in just a sec. And then credit AR. So how much is in my AR account now? If I set up a T account, I'd have a debit for $3,000. And I'd have a credit for 300. So there would be $2,700 left in my AR account, which is exactly right. That's what Good Food Store owes me. The second thing I have to do is it says that merchandise which had cost 180 is returned to inventory. I have got to back out that cost of goods sold and inventory entry from before. Okay. This is basically just reversing a part of this journal entry. So first thing I did, I debited 1,800, credited inventory. Now I got it back. So I'm just going to reverse it and put the inventory back in my warehouse and reduce the expense. Now, on April 8th, I sold merchandise for $1,000. This time I was selling steak to the Good Food Store from a ranch that I had purchased some local beef up the Potomac. So I sold the merchandise for $1,000 to the Good Food Store, and I gave them credit terms of 110 net 30, and the invoice was dated April 8th. And that meat that I sold to the Good Food Store had cost me $700. Make the journal entry, turn off the tape, make the journal entry. Okay, so we know when we make a sale, we've got to make 2 journal entries. One to book the sale, one to book the inventory moving into cost of goods sold. So here are my 2 journal entries. Okay. Every time I make a sale, 2 entries. The Good Food Store now owes me $1,000, debit AR. And I had a revenue of $1,000. Then I've got to move the $700 of beef out of my freezer warehouse because it's no longer physically there. It's no longer an asset, and it has become an expense because I've used it up. Okay, and I've got to match, according to the matching principle, cost of goods sold against sales. So I go do that. Debit COGS, it's an expense. Credit inventory, current asset. Last journal entry on the 11th. I received payment for the amount due from the April 1st sale, less the return. So now I've got to go back up and go, okay, how much did the Good Food Store owe me? So they're telling me that I'm getting the cash from this transaction. So turn off the tape, make the journal entry, try and figure out how much you think the Good Food Store owes me. And then this is just a simple, they're paying me. What's the journal entry look like? Okay. So I had $3,000 in AR, and then I had a $300 credit. So it's $2,700. This is what they paid me. Now, let's pull this all together. And I'm going to give you one more little additional part of the top of the income statement. So we've been learning so far today and last time that I lectured, sales revenue minus cost of goods sold equals gross profit. There's one more little thing that you need to know, which is how do we handle this contra revenue account? You absolutely are going to have to know this model. I'm going to give it to you. So again, say this is my income statement for my grocery broker business. So the top of the income statement is now going to say sales revenue, but I have to subtract 2 contra revenue accounts from that. Less sales, returns, and allowances. And we just saw that up here. All right, I had a sales return and allowance, so that's going to decrease my revenue. And then also, I didn't do it in this example, but just like I got a discount from my vendors, I can offer a discount to my customers. Again, I didn't do that in this example. Now, this model right here is mandatory that you learn this, okay? Sales revenue, less sales returns and allowances, less sales discounts equals net sales. So in this example up here, turn off the tape and do the top. If these were the only 2 transactions I had all month in my grocery brokerage, do the top of this statement. Turn off the tape, use the numbers up here. You probably want to set up T accounts. So I'm going. So I had 2 sales, one for 3,000 and one for 1,000. I had a sales returns and allowance of $300 on April 4th. I didn't have any sales discounts, but I could have, and if I did, we'll do one of those later. So my net sales were $3,700. That was my net revenue. How much was in my cost of goods sold? $1,800 minus 180. So I've got my T account set up, right? Debit of 1,800, credit of 180, and then another debit of 700. So my cost of goods sold was 2,320, making my gross profit, whatever the difference is between that. Gross profit 1,380. Okay. And I would always put a line under cost of goods sold to show that, you know, sales minus COGS. COGS is short for cost of goods sold. Sales, net sales minus COGS gives you gross profit. Okay, and then our last one is E5-11. So in this example, I've got a company. I'm just going to read the intro and then we'll go through these. So Eco Mart Merchandising, they use a perpetual inventory system. The first thing I did on October 1st was I sold merchandise inventory for $1,500 with credit terms net 30, invoice dated October 1st. And the cost of the merchandise was $900. We know, of course, that we've got to make 2 journal entries whenever we make a sale. Nothing fancy here. Debit AR, credit sales. And again, if you haven't done these, turn off the tape, make the journal entries, and then come back and check in. On the 6th, the customer in the October 1st sale returned $150 of merchandise for full credit. Okay, and the merchandise had a cost of $90. So I go up here and I'm like, wow, okay, so part of this $1,500 sale, bummer, got returned. So I've got to recognize that I don't have $1,500 of sales. I've got to debit sales returns and allowances for $150. And then my customer owes me $1,500 less. So credit AR. And then really this entry I made here, I've got to just essentially reverse $90 of that because I'm getting $90 of inventory back. So I've got to debit it to increase the amount in my warehouse, and I've got to reduce my expense of $900. So that would be these two journal entries right here. Okay, then on the 9th, I sold merchandise for $700 of cash, and it cost me $450. So this time I'm not using accounts receivable. I'm actually using cash because they paid me cash. It's not accounts receivable. And then I had a cost of goods sold. I moved $450 of inventory out of my warehouse, so I have to credit it to decrease my asset and increase COGS. And then on the 30th, I got money, I got payment for the amount due from the October 1st sale, less the return on the 6th. So I'm going to go up here, I'm going to set up a T account. So I'm in my T account, which is going to be accounts receivable. I have a debit for $1,500, which is what they originally owed me. And then here on the 6th, I decreased it by $150. So when I get my check from my customer, it's for $1,350. Okay, so let's go back. What I'd like you to do for our next class period is right here. So these are exercises. These are going to be a little bit longer. We're going to continue to practice this. I've got one more concept I want to show you today. So you absolutely need to do these for Monday. Yeah. Okay. And so then the last thing that I want to show you conceptually is from our slides. And this is something that we have to recognize that pertains to how products move back and forth between warehouses and customers. Okay, so this is purchase and transportation costs. So basically this is just an infographic that shows like, or a pictorial that shows like, okay, let's say I just got some shipping containers in from China full of Halloween decorations, and it's sitting in Seattle in port. Then it's going to get on some sort of train or truck or whatever, and it's going to end up in Michael's, right? So there's two ways that you can ship product. One of the ways that you can ship product is called FOB, shipping point. And that FOB stands for free on board. So I always have to think about this like, okay, free on board shipping point means that the person that's shipping doesn't have to pay the freight because it's free on board. So if the shipper doesn't have to pay, who pays? The buyer. So the buyer is going to get the freight bill, okay? It's going to come probably from, you know, let's say from a trucking company, from DSL Trucking. And it's going to say, hey, you owe me, you know, $800 to ship all those. Michael's, you owe me $800 for shipping all those Halloween decorations from the port in Seattle to the warehouse in Spokane, okay? So Michael's is going to debit merchandise inventory and probably credit accounts payable, okay? Because they're going to pay DSL down the road. Why? Because the cost of transportation belongs in the asset account called inventory. It's part of the cost basis, okay? Conversely, if it's the negotiation between Michael's and the company that is selling the Halloween decorations, they said, hey, we're going to buy all this these Halloween decorations for you, but it's FOB destination. Then free on board destination means Michael's does not need to pay. The company from China needs to pay. Okay, the shipping point needs to pay. In that case, Michael's isn't going to get a bill. It's not going to become a part of their inventory at all. And the shipper is going to have an expense. Okay. So free on board shipping point means the buyer pays. Free on board destination means the seller pays. So look at this example. Zmart purchased merchandise on terms FOB shipping point. So who paid? Free on board shipping. Seller or buyer? So buyer. So great, I've got that piece of information. Now the next thing I've got to figure out is, if I'm doing the books for Zmart, am I the buyer or the seller? I purchased merchandise terms FOB shipping point. That means I'm the buyer. I paid the freight. Therefore, I've got a debit inventory for 75 bucks. It becomes part of the cost basis of my inventory. So now we've got just a little bit more of a overview of the model that goes into what is all sitting in your inventory account. Okay, I wish this said just how you would set up your inventory account. So say that those Halloween decorations, the cost was $235,800 was how much I agreed to buy. Then I paid within the discount period. So I get a $4,200 credit to the inventory account because I paid my bill within the discount period. Then when I unloaded some of them, I'm like, oh, some of these are defective. I sent them back. Again, credit to the inventory account. And then I get a bill from DSL Trucking, and I've got and it was FOB shipping point. So I paid for the shipping. I'm going to debit transportation. I'm sorry, I'm going to debit my inventory account. And the real cost of those Halloween decorations that I'm going to turn around and mark up and sell in Michael's, in my store, was $232,400. Okay. Great. I know this was a lot, but you just need to keep working through it. This chapter is literally all about just plugging through the homework. So please finish reading the chapter, do your reading quiz, and prepare exercise 5-1 and exercise 5-3, and we will see you. Bye.